A sovereign bond auction begins with a piece of paperwork. Not a headline, not a speech, a notice. A desk lamp buzzing, the blue glare of a screen, a coffee ring drying beside a keyboard, and a single page titled Offering Announcement, with a security code, a maturity date, and a sentence that feels almost rude in its simplicity. Bids must be submitted by a fixed cutoff. This shouldn't be possible, yet it's how the system works. Because that small notice doesn't just raise cash, it manufactures the benchmark price of money. This is the balance sheet of civilizations, and you live downstream of this whether you know it or not. People think interest rates are set, but the most important rates are often cleared through repeating sovereign auctions that quietly print the yield curve the rest of finance must reference. So let's touch the object before we touch the mythology. Read the notice like it's a shipping manifest. Total amount offered, how bids are submitted, and the line that decides the auction's personality, how winners pay. Here's the weird detail, and it is one detail. In a single price auction, every winning bidder pays the same price, even if they bid differently. That sounds like it can't be real. It's real. The auction clears at a single stop yield, and all successful bidders pay the price implied by that stop. If you were more aggressive than someone else, you don't get punished by paying more. You just improve your chances of actually getting the bonds. And that changes the psychology. People think the goal of bidding is to be clever, but in this format, the goal is often to be honest about your true demand while staying within your constraints. If you shade your bid too far away from reality, you don't merely save a little. You risk getting shut out and being forced to buy later at worse terms if you need the instrument for hedging, collateral, or benchmark exposure. People think auctions reward bravado, but in sovereign markets, auctions reward survival under constraints, what your balance sheet can carry and what your funding can support. Now the thesis, stated without poetry. The sovereign debt auction is where the price of money is made because it produces the benchmark term structure, the curve of yields across maturities, and that curve becomes the discount rate embedded in private borrowing and asset valuation. People think their mortgage rate is negotiated at a counter, but the counter is quoting off a curve that was minted in an auction. This isn't conspiracy talk. It's a deadline, a bid ticket, and a settlement rule. A few boring things that move trillions. Now we state our single paradox, cleanly, and only once. The risk-free benchmark, the foundation under private finance, is created by the largest borrower in the room. That sounds backward, and here is the resolution. Risk-free is less a moral judgment than a plumbing convention. The instrument treated as universally acceptable collateral, liquid enough to finance, and embedded into the rule sets that keep institutions operating when stress arrives. The system crowns it risk-free because the system is built to use it everywhere. People think safety means no one owes anything, but in modern finance, safety often means everyone accepts it. Now we open the machine, and we only need one stage model to do it. There are 3 layers to how an auction becomes the price of money. First, the auction clears and prints a benchmark yield for that maturity. Second, the secondary market turns that result into a tradable reference point. Third, the bond becomes collateral, financed and pledged, so its pricing seeps into the funding layer that tugs on everything else. That's the stack. Everything else is consequence. People think the yield curve is a picture, but it's a manufacturing line. Layer 1, clearing. Picture the auction window as a narrow door. It opens, bids flow in, it closes. After that, there is no negotiating, only arithmetic. And the arithmetic isn't just about opinions on fair value. It's about who needs the paper and who can hold it. Some bidders are long-term holders that want the bond as a safe place to park capital. Others are intermediaries that must warehouse inventory, make continuous prices, and keep their hedges tight. Different motivations, one clearing price. On the bid screen, there are only a few fields, quantity and yield, then a submit button that doesn't care about your story. But behind the screen is the document that actually governs behavior, the internal limit sheet. It states, in plain corporate language, how much inventory you can hold before capital costs jump and your desk is forced to slow down. People think bidders are expressing belief about the future, but bidders are also protecting their own ability to keep operating. Here's how the stop yield is born. The platform ranks competitive bids from the lowest yield, highest price, most eager buyer, toward higher yields. It accepts bids until the offered amount is exhausted. The highest accepted yield is the stop. Below it, you fill. Above it, you lose. At it, you may get only part of what you asked for. That stop is a marginal price, not a comfort blanket. People think the auction yield is an average of everyone's view, but in a single price format, it is the edge of acceptance, the last yield that clears supply. That makes it informative, and sometimes volatile, because the margin is where constraints bite first. And notice the quiet asymmetry. If you wanted the bond badly, you bid low yields and took the risk of winning. If you wanted to be cautious, you bid higher yields and accepted the risk of getting nothing. Either way, the clearing price exposes the crowd's willingness to absorb supply under the current constraint set. People think the auction ends at the announcement of results, but it ends at settlement. And this is where the story becomes tactile. Touch the settlement instruction. It is a rigid paragraph. Delivery versus payment, cutoff times, and the rule that securities and cash must move together. If that movement fails, the safest instrument in the system becomes temporarily unusable, and everyone who depended on it scrambles, not for ideology, but for operational reasons. Settlement is where risk-free can be embarrassed. Even if the issuer is trusted, a failed delivery can break trades, trigger contractual remedies, and force positions to be financed longer than intended. The market has names for these events, but the reality is simpler. The pipe didn't clear, so the system temporarily treats even the best collateral as inconvenient. People think risk-free means nothing can go wrong, but the system's first kind of risk is often the dumbest kind. The pipe doesn't clear. Now layer 2, the secondary market. Once the bond settles, it becomes live inventory. Dealers quote it and distribute it. Investors trade it. Hedgers use it to anchor exposures. The bond stops being new issuance and becomes a shared reference point, a price everyone can see and transact around. And the curve isn't printed once, it's refreshed. Across a spectrum of maturities, repeated issuance and trading keep updating the benchmark map of time. People think the curve is a theory, but it's a running tally of what the world demands to lend for short, medium, and long horizons. People think the auction print is the benchmark, but the benchmark has to stay alive, and that requires trading. Even before settlement, many systems allow a pre-issuance market. Participants trade the upcoming security based on the announcement. That trading is a rehearsal. It lets bidders hedge their future allocation risk, and it lets the market converge toward a reference price before the stop is even known. When the auction prints far away from that expectation, everyone learns something about hidden demand, or hidden constraint. People think auctions create prices from nothing, but many auctions crystallize a price that has already been argued in shadow. Now the punchline that most explanations hide: trading requires funding. Dealers warehouse inventory so the market can function, but warehousing is balance sheet. Balance sheet is expensive. If your inventory costs you more to carry, you demand compensation, and that compensation shows up as yield. This is why liquidity and funding are not side topics. They are part of the benchmark. People think the benchmark is pure, but the benchmark carries the fingerprints of its intermediaries. Layer 3 is where that funding becomes explicit. Open a repurchase agreement confirmation, repo, in market shorthand. It reads like something a lawyer tried to make boring. You exchange a security for cash and promise to reverse the trade shortly after at a slightly different price. That tiny difference is the financing rate. The security you posted is the permission slip that makes the cash move. People think collateral is backing, but collateral is access. Collateral is the key that turns funding on. Now notice the feedback loop, because this is the hidden lever. If the newly issued sovereign bond is desirable as collateral, it can be financed cheaply. If it can be financed cheaply, more bidders can carry it. If more bidders can carry it, more bidders can show up aggressively at the next auction. The stop can clear at a lower yield, and the curve shifts, not because the world became kinder, but because the benchmark became easier to finance. People think rates move on emotion, but rates also move on the cost of carrying inventory. This is also where the risk-free idea becomes operational rather than philosophical. Institutions do not treat an asset as special because they admire it. They treat it as special because it behaves well under stress. It can be sold or financed when other assets turn sticky. Rulebooks then reinforce what practice already discovered, and practice then adapts to rulebooks. The benchmark becomes a self-reinforcing center of gravity. People think regulation is separate from markets, but the rulebook is one of the market's biggest customers. People think the benchmark is just a reference, but it is also the system's favorite tool. Now we deliver the single brutal math strike, only once. A 1 basis point shift in the rate paid on $1 trillion of debt is $100 million a year. So bidders fight for fractions of a basis point, like it decides who gets to keep their seat. And the downstream effect is larger than the auction, because the benchmark curve becomes the discount rate society uses to value the future. People think discount rate is academic language, but it's just the rule for turning future cash into a number you can pay for in the present. Take a mortgage. It is a long string of future payments. To price it, the system starts with a benchmark curve and adds a margin for risk and cost. Take a corporate loan. Same architecture. The borrower pays benchmark plus spread, and the spread is only meaningful because the benchmark exists. Once you understand that, you stop being surprised that the same benchmark quietly influences valuations far beyond credit. People think their world is separate from sovereign auctions, but the auction is the place where the benchmark gets stamped. Now, because this is evergreen, we prove the mechanism repeats by looking backward, briefly, and noticing the same plumbing logic wearing different uniforms. Once states learned that standardized, tradable promises could fund them more effectively than improvised borrowing, debt stopped being a private IOU and became public infrastructure. Markets formed around those promises because they were legible, transferable, and, when institutions were credible, settled reliably. People think national debt is only weakness, but across history, credible public debt often created a deep pool of standardized claims that made banking easier to scale and contracts easier to write. In early modern Europe, for example, governments that could borrow long-term at predictable terms created something the private system could build on: a reference price for time itself. A tradable sovereign bond became a shared measuring stick, and once you have a measuring stick, you start building tools around it. Then came the institutional upgrades. Central banks emerged as lenders and market operators. Dealer systems emerged to distribute issuance and quote continuous prices. Clearing and settlement systems became more standardized, reducing the friction of transfer. Each upgrade made sovereign debt more usable, and each increase in usability made the benchmark more central. People think the most important things look dramatic, but the most important things in finance often look like procedures. Now let's talk about how this machine changes without blaming a single villain. An auction doesn't need to break to matter. It only needs to clear at terms the system didn't expect. That usually happens when constraints shift, when balance sheets are suddenly harder to use, or when funding becomes more selective. In those moments, bidders aren't debating philosophy. They are calculating whether they can carry what they win without triggering internal limits, without paying punitive funding, and without exposing themselves to operational headaches at settlement. Here's the part people miss. The sovereign issuer is offering a fixed supply. The market is offering conditional balance sheet. When balance sheet is abundant, bidding looks confident and the stop clears cleanly. When balance sheet is scarce, bidding becomes defensive and the issuer must pay up, not because the bond became morally worse, but because the system's ability to intermediate it has become narrower. And the changes can be small and still matter. A slightly weaker bid-to-cover ratio, a slightly larger gap between what the pre-auction market implied and what the stop delivered, a small widening in the cost to finance the benchmark. None of these are news in the emotional sense. They are plumbing signals. They tell you the benchmark factory is clearing under different friction than before, and the curve is adjusting to reflect that friction. People think rates rose is an explanation, but it's a label. The explanation is often the benchmark factory had to pay more to clear supply under the current constraint set. And because the benchmark is used everywhere, small shifts in the factory propagate. A higher benchmark raises the baseline cost of borrowing for households and firms. It changes which projects can be justified. It changes the valuation math people use without even noticing they're doing math. It changes how institutions allocate balance sheet because the return on safe collateral has changed. People think the economy is a story, but the discount rate is the grammar under the story. So we come back to the core claim, now fully earned. The stop yield printed at a sovereign auction is not just a statistic. It is a benchmark reference that flows outward through trading and funding until it touches private credit and valuation. That is what it means to say the price of money is made there. The system repeatedly names the cost of time and then uses that name everywhere. You can ignore this and still be priced by it. So here is your viewer lens, one habit. The next time you hear that rates moved, ask what the auction printed and how easy it was to finance the benchmark as collateral. When those two answers change, the rest of the system's pricing usually follows. even if the public story talks about something else. Follow the auction, then follow the collateral. Because once you see this, you stop searching for a single bad actor. You start watching constraint signals and rule box incentives. And that's why the most powerful price in finance can come from the most boring artifact on a desk, a one-page auction notice, and the stop yield it produces. Subscribe to the Balance Sheet of Civilizations.